Hello, my name is John Turk, and I'm joined by my colleague Michael Gary, and we're with Fiduciary Pension Partners. Recently, there's been a lot of volatility in the stock market and bond markets, and we thought it'd be a good idea to do a presentation on market volatility and what are some of the ways that you, as investors and participants in retirement plans, can manage through that. Now, before we get into that, I'd like to share with you a little bit about Fiduciary Pension Partners. I am one of the directors here, and as I mentioned, joined by my colleague Michael Gary. At Fiduciary Pension Partners, we are a full service RIA shop. We have no ties to broker dealers, insurance companies, private equity. So we are conflict of interest free. We are advocates for you and for our clients and their retirement plans. Some of the services that we offer include fiduciary investment analysis, where we'll take a look at your investment lineup, monitor that, as well as recommend any suggestions or changes. We are also skilled and experienced in different plan designs, profit sharing, safe harbor, utilizing those techniques so that key stakeholders can optimize their benefits through the retirement plan. In addition, we offer a fiduciary briefcase. We typically meet with our clients at least quarterly, and we memorialize those meetings through our fiduciary briefcase. We also provide plan sponsor training to the committee to let them know about their fiduciary responsibilities, the roles, and how they can manage that. And then lastly, we offer employee education to your employees, to your participants, letting them know about the benefits of the plan provisions, and how they can best take advantage of their retirement plans, increase their financial wellness, and optimize outcomes. Now let's get into the meat of the today's topic, market volatility. And we'll cover off four key areas. First, we'll define market volatility for you. We'll also take a historical view of volatility, market volatility. And typically, what we're going through now is not rare. There is a market correction of about 10% that occurs every 18, 19, or 20 months or so. So this is not a rare occurrence. We'll also provide you with a plan to that you can adhere to and utilize during volatility, as well as suggestions on aligning your investments for your long-term plans, your goals, and objectives. Now, let me turn it over to Michael, and we'll talk about
Thank you, John. So market volatility refers to fluctuations in the stock market. When we talk about volatility, we mean how much and how quickly investment prices, such as stocks, bonds, or mutual funds, change over time. High volatility means large and frequent price swings, while low volatility indicates more stable and gradual movements. Several factors can contribute to market volatility, including economic data and indicators, Federal Reserve policies, corporate earnings and business performance, and global events. Market volatility, as John said, is a normal and inevitable part of the market cycle. Just like weather has sunny days and stormy days, the stock market experiences periods of ups and downs. While these price swings may seem unpredictable, they are a natural function of how markets operate. Understanding this and sticking to your long-term investment strategy during periods of volatility can help ease concerns and keep you on track towards your retirement goals. Now, the financial markets are always in motion. Historically, US stocks have entered bear market territory, defined as a decline of 20% or more, about every 6 years, with median losses of approximately 33%. While downturns can feel unsettling, history has shown that markets tend to recover and deliver long-term gains for patient investors. Now let's take a closer look at past market downturns that were followed by strong recoveries and long-term growth. So despite market pullbacks, stocks have typically risen over the long term. This chart illustrates how market volatility is a normal part of investing and how the stock market has historically recovered from downturns. As you can see, there have been several major market declines over the past few decades, triggered by events such as economic crises, geopolitical conflicts, and global uncertainties. Examples include Black Monday in 1987, the dot-com bubble burst in the early 2000s, the global financial crisis of 2008, and more recent events like the COVID-19 pandemic and the invasion of Ukraine. However, frequent portfolio evaluation can sometimes lead to risk-averse behavior. A short-term focus may cause investors to become too conservative, making investment decisions based on emotions rather than long-term objectives. Constant exposure to market volatility can push investors toward lower risk investments, even when their time horizon allows for greater risk taking. A Fidelity study on myopic loss aversion, the tendency to feel losses more intensely than gains, revealed that investors are only willing to take a risk when the potential gain is twice as large as the potential loss. This psychological bias can lead to overly cautious decisions that may hinder long-term growth. While market downturns can be unsettling, the key takeaway is that what happens afterward. Despite short-term declines, the market has consistently rebounded and followed an upward trajectory. This reinforces the importance of staying invested and focusing on long-term goals rather than reacting to short-term fluctuations. It's natural to feel uneasy during a market drop, but history shows that those who remain patient and committed to the strategy tend to benefit from market recoveries. Next, we will explore intra-year declines and how the stock market has historically rebounded with positive annual returns. So this chart highlights the intra-year declines of the S&P 500 and its subsequent returns for each given year. As you can see, market pullbacks occur almost every year in some form. However, despite periods of volatility lasting days or weeks, the S&P 500 has still managed to return positive annual returns in most cases. Now, there were years when market declines were more significant, leading to negative annual returns for that given year. For example, in the early 2000s, the S&P 500 experienced 3 consecutive years of losses due to the dot-com bubble and the impact of 9/11. Another example is the 2007-08 financial crisis, as well as in 2022, when high inflation and recession fears led to a down year for the market. The key takeaway from this slide is that volatility is a normal part of the market cycle. When declines within a given year can feel unsettling, history has shown that the market tends to recover and move higher over time. Double-digit intra-year declines are common, yet in most cases, the market still finishes the year in positive territory, reinforcing the importance of staying focused on long-term goals and not reacting impulsively to short-term fluctuations. So here are 2 basic principles to consider for managing market volatility. First, don't bail at the first signs of a declining market. The markets have been resilient. Sure, there have been periods when the markets have delivered losses, but over the long term, the stock market has trended upward, recovering again and again from the disruptive but ultimately short-term worries of economic crisis and major world events. Being on the sideline has had its costs. It's no fun watching an investment drop in value, yet selling does does no more does no more than lock in the loss and prevent you from profiting from any subsequent gains. Gains often occur during a few strong but unpredictable trading days. Benefiting from those days requires you to be in the market for the long term. Secondly, do you have a plan for investing through market fluctuations? Take advantage of your resources. A financial representative can be your best resource when it comes to establishing an investing plan that helps you focus on the long term. At Fiduciary Pension Partners, we offer tailored plans and advice from our team of advisors that help you navigate these short-term fluctuations while focusing on your long-term goals. Another helpful tip is investing regularly. Investing on a regular schedule allows you to take advantage of market volatility. It's called dollar cost averaging. By employing this technique, you may benefit by buying more shares when the market prices are low and buying fewer shares when the market prices are high. Keep in mind that investing regularly does not ensure a profit or protect against a loss in a declining market. For the strategy to be effective, you must continue to purchase shares in both up and down markets. And lastly, diversify, diversify, diversify. The 3 major asset classes, stocks, bonds, and short-term investments, tend to react differently in different market conditions. By spreading your investments across these asset classes, you can offset the effects of one poorly performing asset class with possibly better performance of another. This can also help manage the risk level of your portfolio. It's also important to remember that diversification does not ensure a profit or guarantee against the loss. I'm now going to pass it back over to John, who will go into a deeper dive of the impact of being out of the market.
Thank you, Michael. And as you think back to that last slide, it's important to remember, do not bail at the first sign of a declining market. And this slide helps illustrate this. At the end of the day, none of us can predict with 100% certainty when the bottom of the market is going to occur, nor when the top of the market is going to occur. So you want to have time in the market and not try timing the market. If we look at a 42-year time frame, January of 1980 to the end of December of 2022, had somebody invested $10,000 in the S&P 500 index and stayed there, kept the dividends, reinvested the dividends, at the end of that 42-year period, that $10,000 would have grown to almost $1.1 million. Now, let's say that participant, that investor, missed out on just the 5 best days of that 42-year period. Their portfolio would have grown to 671,000. Still tremendous growth, but a tremendous hit just by missing those top 5 days. And you can see it's the same story if they're missing the 10 best days, missing the 30 best days. If we look and we say, what happened to that investor who missed the 50 best days of that 42-year period, you can see what would have happened to their portfolio. Yes, it would have grown to 76,000, but they would have missed out on over $1 million in growth. So now let's talk a little bit about how you can manage risk and what can you do. As Michael pointed out, certainly your financial advisor and is a great resource to bounce ideas off of. And at Fiduciary Pension Partners, we are here for you. If you want to have a conversation with us about your 401k or your 403b portfolio or your portfolio in its entirety, that's what we're here for. We're here to help. But in determining that investment strategy and how it might meet your retirement goals or your overall financial goals, important considerations are your current age, when you might need this money or when you might be looking to retire, and what does your current savings picture look like outside of the retirement plan. Typically, experts recommend that you have anywhere from 3 to 6 months of salary saved up outside of your retirement plan for rainy days. If you're a ways from retirement, you've got time before retirement, and time is your best friend. Time helps ride out and smooth out those down cycles. If you are closing in on retirement and you would need access to your money sooner rather than later, then maybe we want to make some changes and consider a more conservative portfolio that shields you from short-term fluctuations and provides you with peace of mind. So let's move on to the next slide. And again, as Michael talked about, another thing that you can take advantage of is diversifying your assets across the major asset categories. And we've got that here, the stocks, bonds, short-term instruments, investments, as these tend to react differently to different market conditions. So by spreading and diversifying your assets across these different asset classes, perhaps it helps offset the effects of one poorly performing asset class with possibly the better performance of another. And this helps manage your risk level of your overall portfolio. Of course, we must caution diversification does not ensure a profit nor guarantee against a loss, but it sure helps. Let's talk about some other do's and don'ts, best practices, right? Keep your perspective. Downturns, as we talked, opening up the discussion. Downturns are a normal part of the investment cycle. Typically, a 10% correction happens every 19 to 20 year months. Create a plan that you can live with and manage through the ups and downs. Focus on your time in the market, not trying to time the market. It's always a good idea to keep investing through your 401k, through your 401k, through your 403b, and have that money consistently coming out of your paycheck so that you're utilizing dollar cost averaging. And again, consult with your financial advisor. We are here to help and here to help you manage through market volatility. So now I'm going to turn it back over to Michael to bring us home.
Thank you for that, John. So, as John and I have alluded to throughout this presentation, at Fiduciary Pension Partners, we are here to help. We offer complimentary one-on-one consultations, and during these sessions, we'll offer tailored, personalized advice based on your current portfolio and account, and we'll also review your goals for retirement, and we'll offer advice and guidance on the proper investments vehicles to select. You can contact us at 833-377-4015 or email us at info@fiduciarypp.com. We're more than happy to answer any questions you may have on the market volatility, your current portfolio, or which investments you may feel better fit your goals for retirement. Thank you for listening to this presentation. We hope you have a great rest of your day.